Why strategy is being tested earlier than expected in 2026. For years, enterprise strategy operated with a margin for delay built into its assumptions. Constraints existed, but they were treated as manageable. Transmission would expand, permits would move, facilities would adapt. If friction appeared, time and capital could usually absorb it. That margin is shrinking. What is becoming clear in early 2026 is not that strategy has failed, but that many strategies were calibrated to systems that no longer bend as easily as they once did. Across sectors, organizations are finding that projects can be well-funded, technically sound, and commercially justified, and still stall because the underlying infrastructure or regulatory capacity is not available when needed. The strain is not showing up first in earnings calls. It is appearing in operations. Facilities teams are encountering energy constraints sooner than forecast. Interconnection timelines are shaping development decisions. Compliance reviews are extending further into project schedules. These are not isolated disruptions. They are early signals that the buffer many plans relied on is no longer there. When constraints stop absorbing delay energy, availability offers one of the clearest examples. The International Energy Agency, IEA, has repeatedly warned that grid expansion is lagging demand growth in key markets. For years, that gap was framed as a future risk. In 2026, it is already influencing project sequencing, site selection, and capital timing. Similar pressures are emerging around water access, equipment lead times, permitting capacity, and skilled labor. Individually, each constraint appears manageable. Together, they compress timelines in ways planning models often underestimate. Current research has shown that persistent infrastructure bottlenecks tend to trigger cascading effects, delays in capital deployment, slower hiring, postponed market entry, even when demand remains strong. The limiting factor is not ambition. It is execution capacity. Why early operational stress matters. One of the defining features of this moment is when stress is surfacing. Facilities and operations teams are encountering strain far earlier in the year than leadership expected. Load assumptions are being revisited mid-cycle. Redundancy plans are being tested under real conditions. Compliance questions are becoming immediate rather than theoretical. That timing is telling. Early operational stress is rarely a temporary fluctuation. It often indicates structural limits that will persist, regardless of market conditions. Earlier reporting highlighted why early-year operational signals can be more revealing than year-end performance misses. The same pattern is now repeating across energy, infrastructure, and industrial systems. Decision lag is widening the gap. At the same time, many organizations are experiencing a growing gap between operational reality and executive response. Teams closest to facilities, energy systems, and compliance are adjusting in real time. Strategic recalibration, however, often remains anchored to assumptions formed under different conditions. This delay carries risk. When constraints are treated as short-term disruptions rather than durable limits, exposure accumulates quietly. Timelines stretch, commitments harden, accountability becomes harder to unwind. What distinguishes 2026 is not the presence of constraint, but the reduced tolerance for misalignment. Where breaks first? In practice, the first failure is rarely dramatic. It is a delayed expansion, a stalled interconnection, a permit that takes longer than expected. But those modest breaks can have outsized consequences when regulatory, contractual, or legal obligations are already in motion. Operational limits are increasingly translating into financial and legal exposure, not because organizations are acting recklessly, but because systems no longer have the flexibility to absorb delay. That shift changes the nature of strategic risk, the transition already taking shape. This week's focus on facilities, energy, and operational reality points toward a broader transition now underway. As limits become visible, attention naturally moves toward how risk is governed, how compliance is enforced, and how exposure is managed when execution diverges from plan. That transition is already happening. For leadership teams, the implication is clear. Strategy in 2026 will be judged less by its ambition than by its alignment with physical and regulatory reality. Organizations that navigate this period successfully will be those that recognize limits early, shorten decision loops, and treat operational signals as strategic inputs, not downstream issues. By the time these pressures surface in financial results, they are rarely surprises. They are confirmations. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.